To talk about the economic survey that's been laid on the floor of the House by the Finance Minister and which always has interesting insights into the economic thinking in the Union government, we are joined by Dr. V. Anantha Nageswaran, the Chief Economic Advisor to the Government of India. Dr. Nageswaran, thank you very much for your time. Really appreciate you joining us. What I'm going to do is run our viewers through some data sets from the India Today Budget Intelligence Dashboard and then draw on what Dr. Nageswaran and his team have written in the economic survey to try and give our viewers a sense of what the thinking in the government is on those aspects. And as Dr. Nageswaran mentioned in his speech and then also in his press conference, employment is one of the key areas that this government needs to currently deal with. I've pulled out here data from the Center for the Monitoring of the Indian Economy, which looks at the month-on-month average unemployment rate, which for May 24 stood at 7%, down from 8.1% in April, but at 7%. Some argue that this doesn't fully capture employment. That's a very contentious issue by itself. The annual rate of unemployment for FY24 stood at 8%. So I want to understand first, Dr. Nageswaran, from you about what you think really ought to be done to deal with the jobs challenge. We are hearing a lot about employment-linked incentives, ELIs, to complement the production-linked incentives, that companies should have incentives so that when they hit a certain number of employment creation, then they get incentives. Do you think that's one way of potentially addressing this challenge? How do you think the job crisis should be dealt with?
No, there are multiple interventions that can be undertaken with the aim of creating employment. It is a function of continued economic growth. It is a function of corporate sector's investments. It is a function of the real estate markets doing well, which creates construction jobs. So there are multiple touch points that have impact on employment. From the point of view from the government action, of course, the survey has mentioned the importance of deregulation as a very important aspect that frees up entrepreneurial resources, both time and in terms of financial, to be able to create employment. The second aspect is employment is also influenced by long-term transformations like technological developments. And that is where the corporate sector also has to find the right balance between capital share at work and labor share at work in their businesses. And we showed that corporate profits have gone up in the aggregate by nearly 4 times between FY20 and FY23. Therefore, there is more room for them to hire workers, create incomes for them, which feeds back into better demand for their own products. And so I think the answer to your question is that employment generation is a matter of good, appropriate skilling, where government, private sector, academia have to come together. And employment creation is a matter of easing operating conditions for businesses, especially small and mid-sized businesses. And third, employment generation is a matter of how corporates and commercial businesses deploy technology to the extent that they are labor augmenting rather than labor displacing.
Dr. Nageswaran, in the economic survey, you also write about the challenges posed by artificial intelligence, particularly to India's service sector exports. Just now you spoke about the need for deregulation. In the survey, you write about deregulation at the local, the state, and the central level. I want to understand from your framework the potential you think having a coalition government, rather than a government with a full majority, a coalition government in fractious federal relations, all these having on the prospects for deregulation. What kind of deregulation do you have in mind? And do you think we're now in a fractious coalition framework could push back some of the economic reform? Dr. Nageswaran.
First of all, these are actions that can be taken suo motu by state governments, and whether we have a full majority government or a coalition government is not a factor in this. And state governments in the past have indeed done so with respect to business facilitation legislations, presumptive approvals, etc. So it is possible. And that doesn't depend on the kind of governments we have over here at the union government level. And as to what kind of regulations they are, we have given some examples in the survey chapter. See, ultimately it comes in having too many prescriptive rules for businesses. I mean, there are several legislation that prescribe even the amount of space that businesses have to allocate for receiving inventory, raw material inventory, production space, and finished goods inventory, etc. So it's important to move away from such prescriptive rules to principle-based regulations, especially when it comes to non-financial businesses. That is the kind of direction in which we have to move towards. And when it comes to artificial intelligence, I mean, it is still a work in progress in terms of understanding the implications it has for labor market, for employment generation. But it is very important for Indian point of view to make a distinction again between areas where it can expand employment, and for that, what kind of preparatory work we need to do, and also understand that ultimately the cost of artificial intelligence cannot simply be measured in terms of productivity gains and bottom line gains for the corporate sector, because ultimately, if it is going to be creating a adverse impact on employment generation and income growth, it does feed back into the corporate sector in terms of lower demand and lower sales growth for themselves. So I think all countries are struggling with finding the right balance between deployment of new technologies and their implications for employment markets, job markets, and it has also got implications for the share of income accruing to capital in terms of profits and share of income accruing to labor. So I think over time, we have to figure out, depending on the kind of impact it has, well, a mix of carrots and sticks and incentives and disincentives may need to be adopted to ensure that the social balance is not unduly disrupted.
I want to come now to the issue of private investment, because the government reduced corporate tax in the hope that investment in India will kickstart. And if we look at capital formation, it's really been something that's been discussed again and again by representatives from government with corporate India. And the question really is about whether private investment, gross capital formation is really kickstarting. And one of the things that's often said is that the kind of corporate tax cuts that were given haven't resulted in the kind of investment that we would have expected. So do you want to talk a bit about that, Dr. Nageswaran, the fact that these cuts were given, but if we look at the kind of investment that's happened, the kind of gross fixed capital formation that's happening, it's not of the kind that the government would have expected, and that's always been a bone of contention from the government's perspective.
This is not quite true, because what happened was after the government cut taxes, we had the pandemic. So that's something that nobody anticipated. So in that sense, the 2 years of 1920 and 2021, we had problems with respect to the pandemic and the implications for economic growth, and therefore capital formation would naturally be kept in abeyance by companies. And it is a fact that private sector capital formation did pick up in 21-22 and 22-23, based on data available from the national income accounts. And for 23-24, we are seeing that in the private sector data of a sample of 3,000 plus companies, capital formation continued to grow at the rate of 19.8%, nearly 20% in FY24 as well. So the important thing is capital formation in the private sector, initially after the COVID ended, picked up a lot more strongly in dwellings and construction. Whereas we would love to see more investment happening in machinery and equipment and intellectual property areas, etc., which is what leads to quality employment generation. But even there, in the last 2 years, the progress has been noticeable. So it's not entirely correct that private sector has been holding itself back, because there were a lot of exogenous shocks that we didn't anticipate, like the pandemic, like the war in Ukraine, which had implications for energy prices, etc. So I think it's important to understand that some of these things take time to manifest, and I think they are manifesting, and we will see as the decade progresses that private sector capital formation indeed continues to grow and generating jobs. So I think we should allow for time, because exogenous shocks have been following one after the other.
I want to come now to the issue of foreign investment. Now I want to look at foreign direct investment and foreign portfolio investment, and then understand from the CA how he sees it. So FDI peaked in financial year 22 at $84.8 billion, and then it came down to about $71 billion in FY24. This is as far as foreign direct investment is concerned. So let's start with foreign direct investment. Your outlook when it comes to FDI coming into the Indian economy at this moment, your critics, the government's critics, not your critics, the government's critics would argue that the government's claims on FDI have been much bigger than the graph would suggest.
No, I think first of all, FY25 just barely started. First of all, we don't even have data for the full quarter. We may have data for April and May. And so I think to be able to say that we are comparing $17 billion of FY24, which is 12 months with 3 months data, isn't quite fair. But I think in general, India's
which is $71 billion versus FY22, which was 85. My point largely is your outlook on India's attractiveness as a foreign direct investment destination at this moment and how you see these numbers move.
Yeah. So first of all, India's FDI inflows between FY23 and FY24 have been largely similar, despite the fact that FDI flows into emerging markets were actually quite significant, had declined quite significantly. And if you look at the FDI announcements, whether it is the UNCTAD reports or the Financial Times' FDI intelligence, India figures very prominently in the FDI intentions or FDI announcements by foreign investors. And last year in particular, what happened was many venture capital and private equity investors took advantage of the valuations and liquidity offered by the Indian stock markets to exit profitably, which is also very important for FDI flows to come in. So on a net basis, last year, in FY24, that is, we witnessed a decline in the FDI numbers, but that is, I would say, is a healthy sign of a market facilitating exits. At the gross inflow level, compared to what happened to the rest of the emerging markets, India actually maintained its overall FDI inflows, including reinvested earnings. And announcements and intentions by foreign investors puts India very high on the map of investments. And we are competing not just with other emerging markets, but even with advanced nations, which are now heavily subsidizing reshoring and onshoring of investments. In all this milieu, therefore, considering all these factors, India's FDI inflows are actually maintaining a healthy, sustainable trend. But that doesn't stop us from continuing to do what we have to do to attract investments in the areas that we want investments to come in, to make our manufacturing sector grow and receiving critical technologies, etc. Back to you.
Okay, I now want to come to consumption. And I'm capturing here FMCG sales as an indication of consumption. We've seen a lot of these FMCG companies come out in their investor calls and speak about how there seems to be some distress, particularly in rural sectors when it comes to consumption. So A, your sense of, the supposed distress around consumption in rural areas, and B, even if we look at the year-on-year change in food and agro-based product sales, this is FMCG sales we're looking at, the year-on-year change in FY22 was 21.2% from on a low base, but coming down to 8.3%. So what's your outlook around consumption? And what are your prescriptive measures on how this issue should be dealt with by the union government?
I think prescriptive measures in terms of boosting consumption comes through employment generation and income growth, and also visibility of that income growth happening for households both in rural and urban India. I think for FY25, as we said, monsoon has unfortunately been so far somewhat on the patchier side, with several geographical regions having not received adequate rainfall, because that is a very important indicator for agricultural income growth and in turn for rural income growth, etc. And in that sense, boosting consumption is not just a matter of tax policy, but in a sustainable basis, it requires employment generation and income growth for it to happen. And that is where we have given suggestions on deregulation, education, skilling, and private sector, which we went through earlier with respect to one of your questions.
In the economic survey, I see you recommend that India allow easier FDI from China, so that we're not just importing from China, but we're actually getting Chinese companies to invest in India. From the way I understand, this seems to be contrary to the thinking that we've seen in the government over the last few years, where they've been imposing tariffs on Chinese companies coming and investing in India. So is that something that you're advocating, change, that India ease investments from China? Why are you suggesting it, and how do you see it play out in a geopolitical context as well?
No, it is not contradictory. It is a analysis that we are doing and showing, and I wrote about it in Mint a couple of months ago or so. Our import dependence on China continues to rise, and we have a trade balance of about $87 to $90 billion trade deficit, and importing goods also has a disincentive for domestic manufacturing capabilities to increase. As long as we have cheaper imports coming, it discourages domestic investment from happening. So in that sense, continued dependence on, so we are engaging with China because our imports haven't come down. Our imports have, our trade imbalance has only widened. The question is, therefore, can we calibrate this engagement with China from only on the commercial side, but also to the investment side, and choosing those sectors, attaching whatever conditions we may want to attach, and still signaling the fact that we are making a balance between importing goods versus importing capital. Because that will also enable transfer of know-how to domestic partners, etc. So that is all that we are throwing open the question, because many other countries are also grappling with this dilemma. While they are subject to import competition, that is why in the presentation we made today, we gave the example of Brazil and Turkey, which imposed bans on import of electric vehicles from China, but incentivized China setting up shop for electric vehicle manufacturing inside the country, inside their countries. That's an example. I'm not saying that is the policy we need to adopt with respect to any particular sector. That needs to be identified. But it is a question of import dependence. A, disincentivizes manufacturing. B, the supply can always be turned off. Whereas domestic production inside the country is a different ball game. It allows export capabilities to grow in the country, transfer of know-how happening, etc. So we need to strike the right balance between the two. And that is an issue we are throwing up for further examination and reflection.
Interesting. So very interesting themes that you've built on. And you're looking at this from an economic prism. It will also be interesting to see how they play out from a defense and political prism.
There are multiple angles to it. Yeah.
Sure, but you're also being prudent, because you're saying, why allow imports to go up from China? Why don't you just allow these companies to come in, invest? It will also create jobs in the Indian economy. So that's one way of looking at it. Let's see what the finance minister says. I have a lot more questions to ask you, but I know it's a very busy day and I won't hold you back, but I hope we'll get another opportunity to talk to you. Dr. Nageswaran, for your time and for your insights.
Thank you.
Thank you so much.
Thank you.